Well, it's a 6:01, so it's the evening time, so we'll just go ahead and get started. Um, Thank you everybody for coming. And we have with us today Amber Miller from our partners at GreenPath and Rahel Young, who is our operations manager, the credit union. And I am going to let Rahel introduce Amber, and they've got a lot of good information to share. So without further ado, Amber or Rahel, go ahead.
Thank you, Carrie. Good evening, everyone. Thank you so much for being here. Today, I am so excited to introduce to you Amber Miller, who's a partner experience manager at GreenPath Financial Wellness. Soon after moving to Philadelphia from the Midwest with community banking experience 3 years ago, Amber started a financial wellness expert at GreenPath. During this time, she obtained National Foundation of Credit Counseling and HUD Housing Counseling certification and provided this counseling nationwide for a couple of years. Amber is extremely passionate about financial education and helping people determine what financial wellness means to them. Now I'm so excited to introduce Amber.
Thank you, Rahel, and thanks for Carrie, and thank you everyone for giving us part of your evening. I know time is precious, especially evenings, so I hope that this is something that you find to be valuable. Like Rahel said, I am with an organization called GreenPath Financial Wellness, and GreenPath is a nonprofit organization that partners with credit unions like USSFCU to provide financial education and resources to people. Today, our goal tonight is really just to make sure that you leave with some practical, helpful information to become more confident financially. But before we talk a little bit more about how to do that, let's start out by talking a little bit about why we're here tonight. Why is it important for women specifically to take charge of our financial futures? So according to the US Census Bureau, women working full-time earn an average of just 82 cents to every dollar earned by their male counterparts, which means according to T. Rowe Price Retirement Savings and Spending Study last year, women's savings and contributions will likely be lower, which leads to a retirement income that is an average of 42% lower than men. The Social Security Administration also reports that women's Social Security benefits tend to be 22% lower than men's, and that gap can get even wider for women who step out of the workforce or reduce the number of hours they work in order to prioritize caretaking. So this means that women may need to plan for additional streams of income in retirement, as Social Security may not be sufficient to cover basic monthly expenses. T. Rowe Price also reports that women's median 401k balance is 65% lower than for men, which again means women are likely to need additional income sources in retirement to cover expenses. And not only are women likely to earn less and save less, but they are also likely to live an average of 5 to 6 years longer than men. Women also tend to have higher healthcare costs, and you will need more savings to have income for more years on average than men. The rest of our time together tonight is going to be spent really equipping and empowering you to beat these statistics so that you can take control of your financial future and hopefully be in a situation where you're not struggling come retirement, but anytime in the meantime as well, to take care of your financial needs. So as we get started, I'm just curious, and this is something that can be a little bit interactive. If you've got a response, please put it in the chat. But thinking a little bit about the psychology of money, and started out by thinking, how do the different money values we learn affect our behaviors towards money? So this is something, if you've got a story or an example that you're comfortable sharing, please do put that in the chat. But money is something that starts really, really young. I remember my parents always kind of drilling in my head, never use a credit card, don't use a credit card. If you can't pay cash for it, don't get it. And it was when I was, in my mid-20s before I started to realize, I think it's possible to use a credit card responsibly and not get into debt and get some benefits. I had my eyes on an airline rewards card that I wanted to travel for free, but it took me a while, and I really, really entered into that with some trepidation, which is probably not a bad thing as a young person to enter into getting a credit card with a little bit of trepidation. But that's something that has just always kind of rang in my head as something that I learned about money early on. The other thing is my dad driving by, anytime we drove by a payday loan store, he would point at that and say, if you are ever in a situation where you are even considering walking into one of those places, call me, call your mom, call your grandparents, call anyone else, do anything you can to avoid going to those places. So I'm, pretty grateful that my parents were pretty open about money and really wanted to set us up for success. But this is something that, I still had to learn a lot of my own things and kind of unlearn some things that I learned as a child, as well as I grew up and kind of figured out what money meant to me. And especially once I got married and my husband and I kind of came together to figure out what managing money together meant like. This is something too that as you are thinking about this, if you do have a financial partner, you may want to discuss some of the learned money values that you grew up and that they grew up with, and have an open conversation together. The two of you may have very similar or very different values and beliefs and behaviors when it comes to money. And this can lead to tension if these are not acknowledged and addressed. These similarities and differences when it comes to how you think about money play a major role in relationships. If you both have the same money behaviors, you could either both be spenders or both be major savers and be really conservative with spending money. Neither of you may be comfortable discussing money if you are kind of in that same boat where you're both on kind of one of those ends of the spectrum together. Think about the implications of that. If you're in a situation where you avoid talking about money, there can be difficulties and tension there as well. What if your styles are different? What if one of you is a saver and one of you is a spender? What could the implications of this be if you're not having these conversations, if you're not working together and have an open line of communication and acknowledgement about these differences in values and behaviors with money? Whatever the case, whether you are very similar with how you view money or whether you are polar opposite in how you view money, it is imperative to become aware of what your money styles are, what your money behaviors are, as well as anyone that you share financial responsibility with. Don't judge each other. This is not a judgment zone. This is a situation where you're coming at this to really understand how you can work together and complement each other to make your money work for you both. So then, how do these behaviors or things we learned about money growing up affect our current behaviors about money? This is something that you can be thinking about and really take into consideration as you think about how you the things that you learned about money growing up affect your current behaviors about money. If you've got any examples to share, please do feel free to chat those in as well for others to see. As we move in here from thinking about how we value money, something that comes up for a lot of us is financial security. And financial security refers to that peace of mind that we feel when we're not worried about money. So we might all have slightly different definitions of what financial security looks like for each of us, but for many people, overarching, this means having enough income coming in to comfortably cover your expenses, not carrying a bunch of debt, ideally maybe being debt-free, having savings available to cover emergencies. There's a lot of benefits of financial security. Of course, it removes stress, fear, anxiety, and replaces those potential feelings with feelings of ease and safety. When you start to think about what is important to you when it comes to your money, this is really the time to think about where you want to be financially, what you want to accomplish. Not only in the future, I know we talked a little bit about retirement to start our time out, but where do you want to be right now? Where do you want to be 6 months from now, or a year from now, or 5 years from now? What are your dreams? What are your goals? Are there any major purchases that you want to make in the future? Is it important for you to be able to go out to dinner once a week or to have a cleaning service? Do you want to work fewer hours or even leave your job altogether? It's important for you to figure out what your goals are and to understand that not everybody is going to share those goals. Figuring out how you want your money to work for you is a really personal decision and something that I hope each of you feels empowered to really explore and really figure out, because that will shape the rest of the money behaviors that we're going to be talking about this evening. So as you start to really envision the life you want to live with your finances, it's important to figure out what you've got to work with. This step is the reality, the practical side. After you spend some time dreaming and envisioning what you want your financial world to look like, it's time to really start putting the steps into action. So understanding your current financial situation puts you in control of your situation and will help you raise that confidence factor. Again, this puts you in control and help you figure out where you're at so you can figure out what you need to do to get where you want to be. So start out by taking a look at your income. This is the money that you have coming in, and really that's all you have to work with when it boils down to it. But one thing that you really need to keep in mind, and you've probably heard before, is it's not how much you have, it's what you do with it that counts. Of course, there are some caveats there where, of course, you need to have enough money to cover your expenses, but it's a situation where whether you're making $100,000 a year, $1 million a year, something less than that, somewhere in between, still having a plan for where those dollars that you do earn need to go and where you want them to go is going to be so important. So if you are being conscious of what you are doing with your money and what the impact of those choices are, you can make smart money decisions one decision at a time. If you're married or living with a partner, or perhaps even considering living with someone or sharing financial responsibility, this is something that you may want to do together, go through these steps together, or at least do them by yourself, but maybe include their income as something to kind of see how this could shake out. And then, of course, share the results with your partner. Have an open conversation about this of, hey, this is where we're at. This is what we've got to work with. How can we make this money work for these goals that we have? Next, you'll want to take a look at what else you have. If you're like many other women and someone asks you how much money you have, you may not be able to tell them exactly. Take some time to take stock of the value of your assets. Look at your most recent statements for the value of your retirement accounts, any investment accounts that you have, even just savings accounts. This is all important for you to have an understanding of what you've got available. Many financial institutions are switching to or enabling you to view your balances online. So write these down, figure out where you're at with assets. Also be sure to think about things like how much is your home worth? How much is your car worth compared to any outstanding loans there, to really understand what assets you have to your name. Next up, where is this money going? So you've figured out how much you have coming in, what's it going back out to every month? Start out by looking at the expected expenses. These are typically more so what we would refer to as bills. I'm going to break this discussion into two different types of expenses. So the first type is our fixed or our regular expenses. These are the expenses that are usually the easiest to track and budget for because they're typically about the same amount every month. They might fluctuate a little bit here and there, but you pretty much know that you're going to have a mortgage or a rent payment. You know you're going to have an electric bill, a water bill, these kind of basic expenses. Again, this would be things like the mortgage, your car loan, your gas and electric bill, cable, cell phone, all of that fun stuff. Some people may consider a credit card payment a fixed expense because many people pay on the same amount each month on their bill as long as there is a balance. Insurance premiums like car insurance, life insurance, disability insurance are often paid less frequently than monthly. Many people maybe pay quarterly or semi-annually on these. The other set of expenses are a little bit less predictable. So groceries, you go to the grocery store every week or you buy them regularly, but the amount that you spend may vary pretty significantly from week to week. You'll want to try and come up with a way to average these expenses out and come up with a rough monthly amount that you can expect to spend in these variable categories. Same thing with clothing. Maybe you don't go out every month and buy $100 worth of clothing for yourself and your family, but maybe you go out at the start of each season, buy some new clothes, and maybe spend a little bit more than that. Let's look at the things that you spend money on without thinking much about as well. This is for a lot of people where those dollars really start slipping through the cracks, and you maybe don't even realize how much you're spending on small things. A $2 cup of coffee, $6 for birthday cards for somebody's birthday that you forgot. Do you ever stop at the grocery store on the way home from work for just one thing for dinner and end up with $20 or $30 worth of things that you've grabbed along the way through the store? Or what if you're dropping your son or daughter off somewhere and they just remember that they need a few dollars for whatever you're dropping them off at? These are the things that can really add up, and they can add up without us realizing them. So when you're looking for more money to spend on the things that are important to you, which is really what this is all about, right? You're reviewing your current financial situation to look for opportunities to make your money help get you where you want to be and spend that money on the things that are important to you. Oftentimes, these variable expenses are where you can find some wiggle room. Once you have all of this information in front of you, it's time to really compare how much is coming in each month versus how much is going back out and how much you're spending each month. Go back and look closely at your expenses and see what changes maybe you can make. You may have to make some adjustments, but this process will give you a more realistic picture of where you are and how you can get to where you want to be. This is something that I always tell people, you are not depriving yourself if you're thinking about cutting back in some areas. You're making sure that you have the money to go to the things you want it to be going to. So for some people, they don't care about eating out. So they're okay with slashing their dining out budget so that they can spend money on something else. For other people, maybe you're busy, you've got a lot going on, and you really value being able to go through the drive-through and grab something to eat for your family. And you know that that's important to you. Totally okay for your budget to reflect that. Everyone's budget can and should look different because it should be reflecting what you have determined is important for you. That's something that I just want to make sure that you know that you have the permission to do. For some people with a budget, that can feel a little bit scary or restrictive, and we can get some clear ideas of what we think a budget should look like. It doesn't have to be bare bones. We don't need to feel guilty. A budget is just you determining what you want your money to go to and how you can be sure that your money is working the way that you want it to be working. So as we're thinking about analyzing this and looking for opportunities to put money towards the things that are important to you, what expenses do you expect are maybe going to decrease in the near future? Or maybe you're in a situation where maybe a loan or a credit card will be paid off and that monthly payment is going to be back in your budget. Maybe your child is going to move on from daycare to free public school, and that's going to free up a huge chunk of money in your budget. What expenses on the flip side, though, do you expect might increase? Are you thinking that you might need a new car soon? That would be a new loan payment. Has your rent been warning you that it's going to increase? Or maybe your property taxes are going up, which will lead to a mortgage payment increase. Taking a look at what expenses maybe are going to increase or decrease soon can help you develop a budget that will be flexible as those expenses do change. And then once you've thought about this, take a look at what changes you feel comfortable making to your spending. For example, can you maybe carpool with a coworker who lives on the same block as you to reduce the amount you spend on gas? Can you maybe bring your lunch instead of eating out each day? Are you using all of those cable stations or all of those streaming services? Can you reduce your cable bill? Can you increase the deductibles on your auto or homeowner's insurance to decrease your premiums? Or maybe hand wash some of the clothes that you used to dry clean. Lots of things here to get creative about, think about, and really just spend a little bit of time figuring out what changes can I make to free up money for the things that are most important for me to be able to spend it on. Another thing to be thinking about is what changes do you want to make? Maybe you want to increase the amount that you're saving in your 401k. Maybe you want to get a certain amount of money in an emergency fund. Maybe you want to be able to buy a life insurance policy or save for a major purchase or get your credit card debt paid off sooner. This part is so individual. Do your actual spending and saving habits match up to the things that are important to you? This is the part where you can really start to feel in control. Getting this all on paper, getting it all in front of you, and really taking a look at what do I want to do? What can I do? How can I make sure that my money is going where I want it to be going? This is something that a financial professional can help you identify what changes you should make to help accomplish the goals that you want. That's something that the credit union can help out with. GreenPath is able to help out with. We're here to support you and help get an outside set of eyes on your situation to give you some suggestions that maybe you haven't considered. And of course, with all of this, get it on paper, write things down. If you're a paper and pencil person, put it into a spreadsheet or find a tool online. If you're more of a tech person that would rather not write stuff out physically, just make sure that you have this all listed out in a place that makes sense for you so you can quickly and easily see where you're at and have that path for how you can get where you want to be. Now it's time to put these plans into action. You've thought about what you want to do, what you can do. Now it's time to not get overwhelmed and remember to breathe. Write down your goals, write down your dreams, define the life that you want. Write down the changes that you need to make to get to them. What can I do to spend less? What expenses can I cut? What protections should I put into place? How can I move money around a little bit? The following tips will help you become a little bit more confident with your finances. Maybe consider reading something about money every day. Look for a money headline or an article in the business section. Something else that can be really helpful is following personal finance social media accounts. You have to be careful, make sure that you're finding somebody that is, giving legitimate and solid advice, but that's a good way to get on top of some money information every day when you're looking through your social media accounts. The more you read, the more you learn, the more you'll retain, and eventually you'll understand more and more about money. Another suggestion is to have a conversation with someone about money, especially with someone maybe who's a little bit more knowledgeable on this topic. Women, we tend to connect more when we socialize. We're quick to ask our friends if they saw that show on TV last night, but how often do we say to a friend, "So I'm thinking about investing in something, what do you think?" We really need to connect to create community, and the more we share, the more knowledgeable we'll become. How about maybe forming a lunch group once a month with a group of women where you get together and discuss finances over lunch? The best place to start when looking for options to kind of figure out how you can get where you want to be is taking a look at reducing or eliminating debt. And the best way to start with this is taking a look at your budget to figure out where you're at, how you can maybe shovel a little bit of extra money towards getting these debts paid off. If you can find extra dollars in your spending plan to accelerate paying down the debt, that means maybe paying more than the minimum payments. You'll be in better shape. Do you have a budget that is written down that you follow? Unfortunately, many of us do not, but using a budget can truly be life-changing. I suggest tracking your spending for 30 days and see where that money actually goes. And then review those results. Are you happy with where those dollars are actually being spent? This is something that's really important to do, even though we just went through kind of that analyzation process. Actually tracking that spending maybe shows that your money's not going exactly where you thought it was going. So keep track of where you're spending every dollar for a full month and figure out if these spending habits are in line with your goals. If not, figuring out how you can change that budget and what you can do to make sure that your money is going where you want it to be going is necessary. Through this process, we're looking for changes that you can make in your current spending plan to free up some money to pay down or pay off that debt. Another thing that I always tell people here when they're looking for ways to free up money in their budget to pay off debt is this might be temporary. If you can, temporarily reduce an expenditure, free up some money and get your debt paid off, once that debt's paid off, you can add that expense back into your budget, which is great. So that's another thing that some people find helpful is being able to remember this doesn't have to be forever. This is what are maybe some temporary changes that I can make to get this goal achieved, to get this debt paid off. Another option would be maybe to liquidate some assets. See if you've got some money, something of value available that you could sell that could be used to pay down those debts. Maybe this is something like jewelry or a video game or a vehicle that you no longer use that could be sold. The goal here would be to get rid of something that's maybe collecting dust, that's maybe got value, that's not as important to you, that you could then use the funds that you earn from that to pay off this debt, not increase spending. So think about what you maybe have available that could be liquidated to get some extra money to put as lump sums towards eliminating debt. In general, we do not typically recommend using your retirement accounts to pay down debt. There's a lot of nuance there, a lot of moving pieces. So definitely talk with a financial advisor or a professional to review other options before taking that step. And then another option here would be is if you can lower interest rates on your accounts, that can really help accelerate paying down debts because more of your payment will go straight to the principal instead of so much going straight to interest charges on a monthly basis. Communicate with your creditors, ask about hardship programs or internal repayment plans they may offer. This can be a great place to start. Another option could be to maybe potentially refinance a loan to reduce the interest rate or payments. Talk with your lenders to determine if this is an option that maybe makes sense for you. One strategy that's popular to start tackling debt is what's called the debt snowball. You may have heard of this before. It's a pretty popular debt payoff option. Rather than attacking debts in order of interest rate, say highest interest rate to lowest interest rate, the debt snowball has you pay off debts in order of outstanding balance from smaller to largest. You pay the minimum payments only on each debt. You want to make sure you make all of your minimum payments so you keep building that positive payment history, but make only the minimum payments on each debt except the lowest balance debt. to make sure that those accounts all stay current. But any extra money that you have, whether you free up some money in your budget or you sell off something of value and have an extra lump sum, or you get a bonus or a tax refund and you've got extra money, that all goes towards the smallest balance debt. And once that balance is paid off and that debt is out of the mix, you snowball that by adding that debt's monthly payment to the next monthly payment on the list. The goal is to get quick wins and keep yourself mentally motivated as the snowball keeps growing, as these accounts keep paying off. As you see yourself quickly knocking debts off your list, hopefully you'll feel pretty good about making some progress towards your goals. After you list out all your debts, including their balances, minimum monthly payments, and interest rates in a spreadsheet or on a piece of paper, sort the debts by balance, with the smallest balance debt at the bottom and the largest balance debt at the the smallest balance at the bottom and the largest balance at the top. I remember my mom doing this on a huge, like, poster board size paper so that she had this in front of them. This was posted in her office at home. Each account was listed in order and she had it in front of her, so she knew exactly what they were working towards as they worked towards a debt snowball to pay off their debts. So in this example here, we've got the smallest debt is this $80 medical bill, this medical number one at the top. And after making the minimum payments on all the other debts, you've got $40 to put towards this medical bill. So this is going to be paid off within 2 months, which is great. And debt number one is crossed off your list. Skip ahead 2 months. Medical debt number one is gone, so you'll remove that debt from the list. Now add the payment from medical debt number one, which was that $40, into the payment for the next debt on the list. So this is this family loan whose payment started out at $5. So with the snowball payment from medical debt number one, family loan's payment now becomes $45. So 3 months later, this family loan is paid off. This is erased from the list and now rolled into medical debt number two. 2 months later, medical debt number two is gone. And within 6 months, 3 of these accounts have already been paid off. 3 of these balances are out of the way, which is exciting if you're looking towards getting, again, some small wins to keep you motivated and see some actual movement on your balances. As these debts start to be paid off on a regular basis, you can really see how this can be motivating to keep you working towards your goal of being debt-free. Now we're at the point where $366 per month can go towards that personal loan. We're getting up to those little bit higher balance accounts, but you've got more money that's snowballed towards these by getting several of those other balances paid off. The personal loan gets paid off within a few months, and then that $366 that was going towards it is now added to the $243 minimum payment on the equity line of credit. 16 months later, the HELOC is now paid off. Now that full $1,015 is going towards the auto loan. And another 6 months later, after 3.5 years total, this person is debt-free. Imagine if you could free up an additional amount of money in your budget each month that could also get snowballed. The debt could be paid off even quicker. One of the other options to pay off debt is communicating directly with your creditors to see if they've got any internal options they can offer you. This is not always easy, so let's cover some points of consideration. When you call, make sure that you ask the representative answering the call if they have the authority to reduce interest rates or remove fees. If they don't, ask to speak to someone who can. Saves your time, saves their time. It can be very discouraging to speak with multiple representatives only to have them transfer the call to the supervisor after supervisor and have to start over and over again. You want to get to the person who can help make a decision, get to the person who can help as quickly and efficiently as possible. You also don't want to waste the other person's time, so it's helpful to understand what suitable options may be available, and we'll talk about some of those later in this presentation. If you're looking for a workout option, you must know what kind of payment schedule will fit into your budget. If you can come prepared with what you're able to do, this can maybe lead to you getting the solution that you're looking for versus just showing up and saying, I need help, but I'm not really sure what I'm going to be able to do. This can be extremely important when dealing with creditors who only offer one workout option for the length of the debt. If you agree to an arrangement and then fail to follow through, you might not be given a second chance. So this is something that you want to propose a payment that you know will fit into your budget so that you're sure that you can follow through comfortably on it, so that you're not in a situation where you have lost this chance and are not given another chance. And then finally, keeping good records is essential. You should record who you spoke with, when you talked to them, what was agreed to, include what actions, if any, need to be taken to confirm the arrangements. Let's take a look at the various loan options that a lender may be able to offer you. So the first one is what's called a loan deferment. This is usually a type of a hardship that has occurred. A deferment excuses a person from making loan payments for a set period of time because of a specific condition in their life. For example, student loans can be deferred when someone returns to school or experiences an economic hardship. Interest may or may not continue to accrue while the payments are not required, so it's important to know the specific terms of the deferment. A forbearance is when the lender lets the person adjust payments to a lower amount without any type of financial penalty. The interest on these loans will typically be added onto the loan. In some circumstances, lenders may allow the person to make an interest-only payment until they're able to start repaying back the loan as they originally agreed. To apply for loan forbearance, the consumer has to do so through the lender. They also have to keep in mind that this is up to the lender to decide if they qualify for the forbearance, and it's not something that you're automatically guaranteed. Each lender will take a look at the application and they will cast the deciding vote on whether or not the person really needs a forbearance. If the lender doesn't decide to grant a forbearance on the loan, the time frame for the forbearance will vary and the conditions are determined by the lender and are really important for you to know and understand before agreeing. The next option is what's called a loan extension. This is an arrangement between a lender and a borrower that, as the name implies, can extend the term of the loan. So for example, maybe you are allowed to skip a few payments and then add those back onto the end of the loan term. So maybe you don't make a payment for 3 months now, but your loan takes 3 months longer to get paid off than you originally expected because those 3 months of payments were put on the end of the loan to extend it. And then finally, a debt consolidation loan. This is unique from these other three options in that this is a new loan that would provide enough money to pay off other debts. So going forward, you'd only be paying one loan at a fixed interest rate. This can be a great option, but the consumer must live within their means going forward to avoid starting the debt cycle all over again. If you take out a consolidation loan, pay off a bunch of credit cards, and then end up charging balances back to those credit cards, not only do you have credit card payments again, but you also have this debt consolidation loan payment as well. Another debt workout option is what's called debt settlement, which is settling the debt for less than it's owed. And this is an agreement between a debtor and a creditor that allows the customer to pay off debt at a reduced amount. There are pros and cons to this approach, so let's take a look at some of those now. First, let's start out by looking at the person or you as an individual settling a debt on your own. So the biggest pro here would be that if a debt is settled for less than it's owed, this can be a great benefit. You're paying less money to repay the debt balance, which is great. However, you may need a lump sum of that money and must negotiate that settlement with the creditor. It's up to the creditor if they're willing to agree to a settlement and how much they're willing to agree to. It's again not guaranteed. So this is something that you would need to negotiate. And if you come to the table with the lump sum of cash to be able to say, I'll pay this right now, that it can help with the negotiating power, but can be a little bit tricky. Another thing that is important to be aware of with debt settlement is that it can damage credit because the debt will be reported as settled for less than agreed or settlement accepted versus paid in full. Additionally, any amount of debt forgiven, if it's over $600, is considered to be taxable income by the IRS, and so that forgiven amount is taxed accordingly. The amount forgiven will be reported by the lender on a 1099 IRS form as income that needs to be claimed when you file your taxes. And finally, there are third-party companies out there that say that they can help you get settlements, but these come with a risk of getting scammed or at the very least ending up with additional stress and headaches. So if you're considering working with a third-party settlement company, you are typically going to be told to stop making your payments to the creditors, not even the minimums, and instead pay money into an escrow account with the debt settlement company. Once that account has accumulated enough money, the third party reaches out to attempt to negotiate with those creditors to try and settle in cash for an amount less than the outstanding debt. The thing with this is that the customer must also pay the third party for their services, so it will take longer to save the necessary funds to settle the debt. It can take months before creditors are contacted. In the meantime, debts go unpaid, your credit is being damaged as those late payments are starting to be reported, those balances are growing with late fees and nothing being paid towards them. And your creditors are going to be ringing your phone off the hook, wondering what's going on. Why aren't you paying them? Why aren't we in a spot where you're sending these payments? And creditors can still pursue legal action, which could result in judgments and garnishments. If you're paying a settlement company and they don't know what's going on, there's nothing stopping the creditor from pursuing legal action to attempt to collect on these debts. I'm not saying any of this to scare you. There can be situations where debt settlement can be a good option, especially if you're talking about like collection accounts or accounts that have already been charged off. But only about 1 in 10 consumers participating in debt settlement actually ends up debt-free in the promised period of time when working with a third-party company. This was according to a consumer alert issued at the end of 2012 by the nonprofit National Association of Consumer Bankruptcy Attorneys. So all of that to say, if you're considering debt settlement, if this sounds like an option that makes sense for you, do your research, do your due diligence, be very, very careful, be very sure that the company is doing what they are claiming that they are doing for you. The final debt repayment option we will discuss today is what's called a debt management plan. And this is usually a lesser known option offered by nonprofit credit counseling agencies like GreenPath, in which debt balances are repaid in full within 5 years at the most. So we work with your creditors to ask for concessions like lower interest rates and waived fees that make it more manageable for those balances to be repaid in full. Just a few key differences between debt management and debt settlement. With a debt management plan, debt balances are repaid in full and will be reported as paid in full on your credit report. Your creditors are also going to continue getting a payment every month. They're fully involved in the process. They agree to work with a debt management plan. They agree to offer these concessions. They agree to accept a specific payment. Creditors are not left in the dark like they would be with a debt settlement company, and your credit score is likely to increase over time as those payments continue to be made on time or get back on track if you were behind, and as your balances go down a little bit more aggressively. I know this is a lot of information, so I just want to give you a quick example of what a debt management plan can look like in action. One really cool thing about the debt management plan is it combines a lot of these other things we've talked about. It's a combination of the debt snowball, of the talking to the creditors to get lower interest rates, the consolidation. It's really includes attributes of all of those. So let's say someone has 4 credit cards, all with pretty hefty interest rates ranging from 15% to almost 30%. This person has roughly $15,000 in balances spread across these 4 cards, and currently they're paying $740 a month just in monthly minimum payments. And with these high interest rates, we estimate they'll be sending their creditors that payment every month for 12 more years. 12 more years, even without any further charges to the card. $740 is a lot of money, and it's totally understandable why someone may be feeling frustrated about throwing that much at these cards every month, only to see most of it go straight to interest instead of making a dent in the balance itself, especially for 12 more years. Based on the policies of these 4 creditors, however, and what they're able to offer on a debt management plan, we're looking at significantly reduced interest rates through the debt management plan. Single-digit rates for 3 of the 4 cards, and even that 4th card that doesn't quite go down to single digits, it's still reduced by about 7%. And then because these rates are so much lower, less of the payment needs to go straight to interest charges each month, so the monthly minimum payments drop too. In fact, for this person, those monthly payments drop nearly $300. So not only will this person be saving thousands of dollars in interest over the time it takes to get this debt repaid, but they're also saving money each month as well. This $300 is going back in their budget as money that can help them reach their goals, that can go towards what's important to them, like we've been talking about. The other bigger piece of this here too is that this $15,000 in credit card debt will be paid off in full within 5 years, which feels like lightning speed after somebody's been looking at a 12-year payoff estimate on their monthly statements. I do want to clarify here, if you reach out to GreenPath for a financial assessment to explore debt options, that's something that's free and confidential through our partnership with USSFCU. However, there is typically a fee for those who choose to enroll in the debt management plan. Those fees are regulated by state laws based on where you live. These fees will not exceed $75 per month, and the average fee works out to be about $38 a month. Fees are typically based on how much debt is included in the program, so that fee could be as low as a few dollars if the total debt balance or number of creditors is low. Again, it varies from state to state and depends on those regulations for where you live. However, oftentimes, like in this example, the benefits of the debt management plan hopefully far outweigh the fee for someone, especially if we're able to get those significantly reduced interest rates, lower monthly payment, and a significant amount of money saved in interest over the life of this debt. So for this example that we're looking at here, even if we factor in that average fee of $38, this person still has $260 more freed up in their budget compared to their current monthly minimum payments. So GreenPath is a nonprofit organization. We're not out here trying to get rich. These fees go to help us cover our costs to support you throughout your entire debt management program. So again, this is something that GreenPath offers. If you're interested in knowing more, visit that this link that I'm putting in the chat for our shared website, and you can get a little bit more information or reach out to GreenPath. And we can talk to you in more detail about any of these options. We're not here to sell you on a debt management plan if it's not a good fit. We can talk about pros and cons of any of these debt repayment options that we've talked about tonight. Let's shift gears here a little bit to student loans. So student loans have their own unique options associated with them. If you have student loans, you'll need to understand what type of loans you have to know what repayment options are available to you. So you can go to the National Student Loan Database website to determine the loans that you have, and visit studentaid.gov to learn about all of your options for repayment of federal loans. Keep in mind that while it may be possible to lower your student loan payment, making that change will extend the amount of time it takes to repay that loan and increase the amount you pay to the creditor overall. It all goes back to what your short and long-term goals are. Keep these in mind as you decide what student loan repayment options are best for you. This is especially important to be aware of right now, as federal student loan repayment is expected to begin again after this 3+ year long payment pause that we've been on. The Supreme Court is currently making a final decision on the student loan forgiveness plan that was announced last fall, and payments are expected to resume later this summer or early this fall after that decision is announced. So even if your student loans are not due right now, it is still very important to find out who your loan servicer is, especially because many servicers changed during this payment pause. Both my husband and I's student loan servicers have changed over the last few months even. So it's really important that you know who your servicer is and make sure that your servicer has the most up-to-date contact information for you, regardless of if it's changed or not. Pay super close attention to any communication you receive from your servicer over the next few months, and promptly take the steps they suggest to be prepared for payments to come due. When we switch gears here a little bit to think kind of bigger picture, credit is something that we're going to really spend the next little bit of time talking about here. And it's important to make sure that you know what's on your credit report. And the best place to do that is annualcreditreport.com. This is a website that was set up as a result of the Fair Credit Reporting Act that states you are entitled to receive a free copy of your credit report. That act also states that you can have, or that you have the right to see a copy of each of your 3 credit reports from all 3 bureaus, TransUnion, Experian, and Equifax, for free once every 12 months. Currently, these are actually accessible weekly as part of a change that was made during the COVID-19 pandemic, but this is expected to go back to once a year after December 2023. So you can request these online, or if you would prefer to request by mail, you can do that through any or all 3 of the nationwide consumer credit reporting companies. So you can fill out a form either at annualcreditreport.com and mail that in, or you can call 877-322-8228 to request that form as well. If you anticipate the need to borrow money, however, we suggest you take a look at your credit at least 6 months in advance. So if there are any errors, you have time to correct them before you apply. Or if there is something on your credit that you forgot about or weren't aware of, you've got time to take action and get it resolved before making a large purchase like a new car or a new home or something along those lines. It is also important to be aware that not all creditors report to all 3 credit bureaus, so it is absolutely recommended to review all 3 of your reports closely, as they could vary from report to report. So what can you expect to find on your credit report? First of all, there will be the identifying information. So this would be your name, social security number, date of birth, address, employer. This is used so that whoever is accessing your credit report can match up your information. It's not used as part of your credit score. Next, you'll see the money that you borrow, so open accounts. This includes details related to credit cards, consumer loans, auto loans, mortgages, student loans, any of those other types of debt that you maybe have open. This report will contain information about when you opened the account, whether you pay on time, what the balance is, and your credit limit. Late payments will start to show up if you are 30 days or more late. You may also see closed accounts or collection records. Other household bills typically do not show up on the report. Examples could include medical bills and rent. However, if you stop paying on any of those bills, they can be referred to a collection agency. And once they're in collections, the collector can start to report this debt as an outstanding past due balance. Anytime someone accesses your credit report, this is what's called an inquiry. There are 2 types of inquiries. First of all, a hard inquiry is when someone is reviewing your credit report for the purpose of extending credit, such as applying for a loan or a credit card. A soft inquiry is when you check your own credit report, like at annualcreditreport.com, for educational purposes. And a current creditor reviewing your credit report or a prospective lender may be obtaining your credit report for promotional purposes to make you an offer. Hard inquiries are the ones that affect your credit score, which we're going to talk a little bit more about here in just a second. And finally, there is an option for a consumer statement on your credit report. This is something that you can add. It's not able to be more than 100 words, but it's something that maybe you had a situation that was out of your control that's impacting your credit, and you want to put a statement on there. It does not factor into your credit score, but when someone manually reviews your credit report, they can see that statement and maybe take the statement into consideration when determining if you will be offered that loan. When we think about what's not on your credit report does not contain information related to income, assets, or savings. So a person could be in a spot where you've got excellent credit, but no savings, or on the other hand, be very wealthy, but have poor credit. So the point is that lenders will often look at all of these items together: income, assets, savings, and credit when making lending decisions. The good news is that positive information such as on-time payments of credit cards and mortgages can stay on your credit history forever as long as that account stays open, which is definitely a good thing. Having more good information helps strengthen your credit history and increase your credit score. So as you can see, it's really important that the information on your credit report is accurate. But did you know that many people have a significant error on their credit report? So you'll not only want to monitor your credit report, but you'll also want to know what to do if you find an error, right? So when you are reviewing your credit report, if you spot a mistake, you are entitled to file a dispute. So basically, you'll fill out the dispute form and include documentation of your claim. Then the credit bureau will request documentation from whoever is reporting the information you are disputing. You can submit the dispute to the credit bureau that's reporting the inaccuracy either online, by phone, or by mail using the instructions provided in that credit report. After review, the credit bureau will determine who has the more accurate information. If it's you, the item will be deleted from the credit report. If the bureau sides with the creditor that's reporting the inaccuracy or the perceived inaccuracy, you always have the right to escalate your dispute to the Consumer Financial Protection Bureau. Online is the best way to submit a complaint at cfpb.gov, or you can call 855-411-2372. So another key reason to make sure your credit report is accurate is that your credit score is based solely on the information contained in your credit report. So a credit score is a 3-digit number that tries to quantify the likelihood of repayment. It's meant to reflect how risky it is for a creditor or a lender to extend additional credit to you. The FICO score is the most widely used scoring model. FICO scores have different names at each of the different credit reporting agencies. All of these scores, however, are developed using the same methods by Fair Isaac and have been rigorously tested to ensure they provide the most accurate picture of credit risk possible using credit report data. There's another scoring model that's pretty popular called Vantage. This was developed in 2006 by the 3 major credit bureaus and was designed to compete with FICO. It recently changed to a 3.0 version that has a 300 to 850 range to promote a little bit easier understanding. This model is often used by tools like Credit Karma that maybe provide a free credit score. It's not wrong, but it is important to know that this is going to typically be a different score than a FICO score. So the credit score you see on something like Credit Karma may not be the same score that a lender gets if you apply for something and they pull your FICO score. And then finally here, the lower the score, the higher the risk. So when you have a low credit score, you will probably pay more to borrow money, even if the creditor does agree to extend a loan to you or a credit card. And when you have a higher score, you'll be offered a better interest rate, which will cost you less because the lender is not taking on as much risk by lending to you. Your credit score is based on the factors we see on this slide. The largest factor is payment history. The best thing you can do here is make every payment on time every month. The next biggest factor is amounts owed. The biggest tip here is not maxing out your credit cards, keeping those balances relatively low compared to the maximum limit of your cards. The next factor is length of credit history. This is something that you'll have to have a little bit of patience for. It'll take several years for the length of your credit history to build up. The last 2 factors are each about 10%. The first is new credit. The best tip I can give you here is not applying for credit too often. This is where those hard inquiries are reflected. Of course, from time to time, we're all going to need to apply for something, which is understood. Just be sure that you're being strategic when you do that. And then the final factor is types of credit. Having a mixture of loans and credit cards helps, but don't overdo it. Making sure that you've got a well-rounded profile on your credit report can be really, really valuable here. Again, a few things that are not included in determining your credit score: income, employment, where you live, race, age, gender, religion, national origin, marital status. None of these are things that have any weight in your credit score. So let's review some tips for using a credit card wisely. First of all, have money in savings as a backup so that you can handle an unexpected expense without getting into debt using your credit card. This is a really, really great place to start. The next tip here is consider only making 1 charge a month on your credit card. Make this charge an automatic bill, maybe a Netflix subscription or a cell phone bill. The reason we suggest setting up only 1 automatic charge is that you really only need to generate activity to build your credit score. It doesn't matter how much activity. In fact, the smaller the balance, the lower your utilization, which, as we just talked about, accounts for about 30% of your FICO score. So setting up 1 small automatic charge each month to this credit card ensures that you will not succumb to the temptation when it comes to overspending. The next tip here is using less than 1/3 of your available credit. The lower your utilization, the better. So a general rule of thumb is to keep your balance at or below 30% of the available credit card limit. For small limits, this means only charging a very, very small amount. And then another thing here is while paying off an account in full does not improve your credit score per se, paying on time is what really matters. Paying off the balance in full every month when you get your statement will prevent any finance charges from accruing. It will also help you live within your means without increasing debt and keep that utilization lower by keeping your balances lower as well. And then the final tip for using credit cards wisely is making sure that you check your credit report and score regularly for accuracy. Make sure everything that's on there is yours. Make sure that it's reporting correctly. As we get closer to wrapping up here, we've covered a lot of ground, but I just want to get back to this topic that we really started our time together with, which was the gap in women's retirement and investment accounts. So once you have a home, you've funded your emergency savings account, your monthly debt payments are at a comfortable level, you can really start to build a nest egg. This can begin or continue if this is one of those things that's important to you and one of those goals that you have. So with investments, it is important to remember that higher risk usually means higher returns or higher losses. So as we think about the different types of investment vehicles that are available, a stock is ownership in a company. Bonds are debt for the issuer. You are the lender. You lend money for a promise of return of interest payments. Mutual funds are where you pool your money and diversify within each class with mutual funds. There are also things like CDs and savings bonds that are available. Typically, most investments result in increased value over time. There are also different retirement plans that are available. If your employer offers a match for something like a 401k or a 403b, do your best to snatch that match. If your employer says that they will match 4%, make sure that you're contributing that 4% so that you're not leaving money on the table. Max these out if you can, and then start an IRA. There are typical limits for what you can contribute annually to retirement funds. So get those maxed out and then start an IRA. A Roth IRA, the money is taxable when it goes in, but when it comes out, that is tax-free. Tax-advantaged investments will grow much faster over time than taxable investments. And the sooner you can start investing, if you're young, it feels like retirement is forever away, still take advantage of the time that you have to see that the investment really grow and compound over time. If we also know the comings and goings of our money and we know what our investments and our assets are and have begun to invest in them, the next step is protection. So without a proper protection plan in place, all you have saved and invested can be wiped out in one quick minute. So how do you protect what you have? Well, there are many ways. First, most important and often overlooked is having an emergency fund, at least 3 to 6 months' salary if at all possible. This emergency fund can be used if you or your partner were temporarily out of work, the car breaks down, medical bills come out of nowhere. These are some things that can cause us to dip into our savings. For most of us, auto insurance is our first basic insurance protection to protect our vehicle. Then maybe we have renters or homeowners insurance when we move out on our own. Disability income insurance when we start earning an income. We start to think about life insurance with maybe the purchase of a home or the birth of a child. We might also buy life insurance when we are young so that we can get good rates locked in. Most of these products can be purchased through a financial professional. However, a financial professional may or may not be licensed to sell all of these products. Some products may also be available through other financial institutions like banks, via direct mail, or the internet. So working with a financial advisor or financial professional is a great way to get the answers to any questions you may have. And then finally, don't be afraid to ask for help or support on your financial journey. Consider working with a financial professional to ensure you are on track to reach your goals. Depending on who you consult with, initial consultation generally is going to be free. Insurance agents typically do not charge a fee. They usually earn commissions based on the product sales. If you're working with a financial planner, some may charge hourly. Again, consider forming networks with other women who can help in this regard. Perhaps someone they trust and can recommend. Ask and shop around before choosing someone. It's okay to meet with more than one professional and choose the one that you're most comfortable with.
So through our partnership with Fellows Financial Group, all members have access to professional financial advisors, fiduciary financial advisors. So feel free to give them a call if you have any questions, whether you know it's day-to-day financial management or estate planning or crisis, anything, they're there. We partnered with them because they are like-minded, like a credit union. They focus on you. No fee for asking your questions or calling them. They're transparent and available to you all. So they are available by phone, email, or on our website. You can go ahead and schedule a virtual one-on-one. And again, no charge to any members here. And then just really quick, we like to end it by telling all of our members that we always have a family referral promotion. So if you are a USSFCU member and want to earn and you like your membership, I would first start by saying that, but feel free to tell your friends and family, and then you each will receive a $50 reward when they open their membership. So if you want to go back to the financial slide, Amber, and check the chat box, make sure everyone's covered. Oh, the Consumer Financial Protection Bureau can also be reached by contacting a senator and in constituent services. All senators' information is available on their website too. But yeah, and there's links to all of those resources to the FTC, all of those things on our website as well. But those are my favorite agencies. They provide free financial resources that are like unbiased, and you can trust them. So check all those out. I hope I answered that right or stated that right. But if there's anything else, I'll let anyone throw it in the chat box. Otherwise, we thank you, Amber, and we thank you all for coming, spending your Wednesday evening with us, and look for that follow-up, and you know where to find us if you need us. So I'm bad at presenting, and then I always end that way. That's why I just monitor the chat box. Okay. All right. Well, thank you, Amber. Thank you, Rahel, and thank you, everybody.
Thanks for having me.